Hello, I'm Robert Luft, Portfolio Manager at Luft Financial with an update on market conditions year to date. Please see our disclaimer regarding the information presented today and that the opinions expressed are those of our team and not necessarily those of IA Private Wealth. So today I wanted to touch on three key themes that I think people are concerned about or asking us about today. Number one being asset class performance, driving market returns year to date. Number two is a discussion on average returns and how those are affected by short-term variance in the markets. And number three, I wanted to talk again about withdrawal strategies. In other words, what's going to work going forward for taking income during the decumulation stage, or what you can expect from your portfolio going forward. So if we look at the slide here, slide 4, one of the things that we're seeing a lot of right now is the headlines regarding the conditions in the markets to the end of May really boosted of this recovery in the S&P 500 and the US stock market year to date. So looking at the slide, this is a really great graphic that we found. It was really just 20 stocks in the S&P 500 accounting for 7.08% of the 7.55% return of the market. So that means that these 20 stocks accounted for 93.7% of the return, just 20 companies. So these 20 companies make up almost 30% of the market capitalization. In other words, the total value of the S&P 500. So this rally driven by tech and AI stocks was really driven a lot by ChatGPT, which kind of became a household name in 2023. So companies like Apple, Microsoft, and NVIDIA have soared year to date. So looking at the next slide, without the AI rally, as of May 17th, the S&P 500, so without those 20 stocks, would have actually returned a negative 1.4%. So think about that. That is a huge divergence of returns. You've got a few companies dominating the stock market. Oftentimes, this will signal higher market risk. So how long can these stocks continue to see higher prices? That's anybody's guess. But this is one of the reasons you're going to see a divergence of the returns of managers, perhaps the US stocks that we're holding versus the overall S&P 500 index. So we're not going to take on that level of risk to chase short-term returns, and we will remain better diversified in all of our US holdings, focusing on more sectors that may be cheaper right now relative to tech and AI for the longer term. In other words, focusing maybe on companies that are trading at lower multiples or lower price to their earnings. So this brings me to slide 6, the next slide on average returns. So it's an interesting number because it's often reported on your statements. So both historically and going forward, if you look at the top of the slide, you see there's a huge range of returns of the S&P 500, of the broader stock market over a 3-year period. So looking at the top there where it says 3-year, you'll see that those returns have averaged, and this is going back to 1871, from a negative 25 to a positive 28. So if anyone's trying to predict a 3-year return for you, good luck. Now, that's still being said, the average was 7.88, but the variance was massive. What this tells you is that your 3-year returns are probably not a reliable predictor of what our experience is going to be for your portfolio over the longer term. In fact, returns are negative over 3-year periods almost 10% of the time. Okay, so to lower your chances of seeing or experiencing lower negative returns from a balanced portfolio, so something that's 60 stocks, 40 income, time and time again, we'll remind you have to focus on your longer term averages. So if we look at it, the 10-year number, for example, on the top of the slide, the average was 7.7%, but hardly any negative returns. In other words, returns were positive over 99% of the time. When looking at your statements, remind yourself that your short-term average returns, which are calculated on those statements are obviously highly influenced, sometimes to the negative, and definitely this year by the events of 2022. If we focused on a 5 or a 10-year number prior to that, you'd get a better idea of your average return going forward. So slide number 7. During 2022, what happened? Well, the typical 60-40 portfolio, the average balanced portfolio declined approximately 16%. Far worse returns than our balanced growth portfolios, but the average of an ETF-driven 60 stocks, 40 bond portfolio was down 16%, according to Vanguard. So Vanguard as well, which is one of the largest ETF providers in North America, expects that due to lower valuations, in other words, prices coming down on stocks, the expected 10-year return going forward will be closer to 6% for that 60-40 balanced portfolio. So how does that affect us? Well, if we look at the next slide, especially as we start to plan for retirement or already in the decumulation stage, sometimes when we have a really bad short-term return number, it can influence our decision-making in the short term. Now, expectations are slightly lower than that longer-term historical, say 7% average, but do we need to adjust our withdrawal rates during retirement based on our asset mix? In other words, does this balanced portfolio still make sense? It dropped 16% last year. Should I maybe move to a higher concentration of stocks? So I picked 2000 as a start date, which was one of the worst years you could have picked to retire. And using a 4% withdrawal rate from that period of time, indexed to inflation every year, whatever the inflation number was over the past 23 years, you'd still have just over $450,000 of your million that we started with. So taking out 40 grand a year on $1 million starting in 2000. So compare that to the person who said, well, I'm going to chase these returns at the stock market now. I'm going to take on more risk. Their all equity portfolio starting in 2000 would have been worth 250,000. It's almost $200,000 less, because during the decumulation stage of retirement, the tried and true balanced growth portfolio will still be the best option for things like your RIF to mitigate the risk of you running out of money. If you chase returns, you generally do so at your own peril during a period of time you're withdrawing money, especially if you have bad returns at the beginning. So the short term, very short term, 1 year, 3 year, presents some outsized returns in some sectors. In other words, AI and tech, for example. But remind yourself, if you over concentrate your portfolio on short-term past winners, it's likely to lead to extreme portfolio volatility at some point that you didn't expect. And if you're taking out money at that period of time, you'll never have a chance to recover. So if we're going to go for a high growth strategy, for example, portfolios that are all stocks, using something like our perpetual portfolio, these are better suited to your accounts where you have longer term time horizon, at least 5 years, and a tolerance for variable returns, and probably don't have the need for short-term income. This would be something like a TFSA account or a specific allocation of non-registered capital that you wanted to put aside for high growth, leaving your RSP in that portfolio that's designed for generating income, just like a pension plan. So I just want to thank you for your time today. If you have any questions, here's a slide of our team. As normal, reach out to any member of our team for help. And I hope you found today's recording and webinar useful.